Hello, everyone. Felipe here. Happy Monday. Hope everyone is doing good and had an awesome weekend. So, as you know, I'm here to keep you up to date with current market news and teachings. This is in no way, shape, or form financial or investment advice. This is for entertainment and hopefully educational purposes only. So, I'll go ahead and jump into what I've been seeing as of late in the market. I've been seeing some interesting things. So basically, first and foremost, which I've been following the semiconductor market, I find it very interesting, right? Because it's the most important commodity, I would say, in modern times. It's used for everything, right? It's in every kind of a technology that you can imagine. It utilizes semiconductors. But as of at least the beginning of this year, that specific market has had massive rallies, led primarily by the AI hype and boom, which has kind of shifted the market and the trend of the market into more of a bullish trend, right? That we've seen with these massive face ripping rallies that have occurred in the tech sector, right? Specifically, the semiconductor market. Driven a lot by the AI hype, in my opinion. But yet the underlying fundamentals of these companies are saying a different story. The actual numbers, right? The actual numbers that you can view, not the actual trend of the charts, are kind of in what you would say a divergence, which is a fancy word in the market, as things are not aligned, which ultimately things always end up converging, meaning they then eventually align with one another. Such as another example would be the oil market, which I find very interesting because it is the lifeblood of any economy. Even unto this day, with the whole AV transition, still crude oil is relied upon much more than electric vehicles or electric renewable energy. It is still the bloodline of the global transportation and just basically economic expansion. Typically, when oil prices are high, it means the global economy is running hot. There's a lot of production going on. If you think about it, that's kind of how it works. So the oil market is also in a divergence, meaning the sellers of oil, such as the corporations like Marathon, ExxonMobil, Chevron, and so forth, their stock prices are extremely high. Which makes sense in a way because they've had record-breaking profits last year during the time the war began with Russia and Ukraine. And that caused, of course, crude oil, the actual commodity, to go up in price dramatically, close to all-time records, but not exactly there, which generated massive profits for these corporations because they were able to just basically make a lot of money due to the high price of gas on the pump and so forth. But the actual commodity, crude oil, has dramatically dropped. I believe it hovers somewhere around like 70 something a barrel. As to shortly after the war last year, went up to a high up to like $122 a barrel. So you can see the actual commodity is down here, but the corporation stock prices are up here. So that's where the divergence comes into play, which one of them are going to have to eventually converge, right? One of them are going to have to eventually align. What side would it be, the corporation or the actual commodity of crude oil? I have no idea, but typically the market always ends up aligning at some point. With that being said, so Qualcomm, one of the big companies that basically produces a lot of the chips, semiconductors for smartphones. That's basically their bread and butter. have been going through some pain, right? Smartphones have been selling a lot less than expected. So they've been taking a hit to their profits due to the slump in smartphone sales. And this goes across the board for all different companies that sell smartphones, such as Samsung, which is a big producer of the semiconductors that are used in smartphones and computers and so forth. And the other is Micron. They're the big guys in the market that produce these chips for smartphones and so forth. So Qualcomm, they basically announced, they gave a gloomy forecast on their recent earnings report, which caused their stock to drop 10% like that after they had a big rally prior to that. 19% rally, and then half of that gone like that really quickly. So it's the tricky part about these trends. What goes up comes down very fast when something shocks the market, which not a lot has shocked the market as of late, including some of the, I would say, negative news I've seen, which I'll kind of go into in a little bit. So yeah, stock price had risen 19% this year, kind of along with the overall tech market has just been on an upward trajectory due to the AI hype and everyone just jumping in. But basically the smartphone demand, or they kind of advise the smartphone demand has dropped and has kind of continued dropping, and that caused Qualcomm stock to drop 10% after their earnings report, which is basically just half of their actual run up, right? Very quickly. So Qualcomm has executed well what was a difficult period for several chip firms due to the slump in demand for consumer electronics. So basically people are buying less electronics, and in buying less electronics, their manufacturers are buying less of these chips that go into the production and putting these electronics together. However, it seems that automotive business has been growing, which is a plus side for this specific business here. Another thing I find interesting, which kind of pivot here, and then I was kind of thinking, and I come to this interesting conclusion about this, which I'll kind of go into a second. So JP Morgan, one of the big guys in I would say the biggest banking business in the United States, right? Recently lost 75, I believe, billion in institutional deposits. Institutional deposits are basically what they call in Wall Street smart money managers, hedge funds, corporations, and so forth, have taken a lot of money out of JP Morgan recently, seeking higher rate of returns. Because think about it logically. Why would you have your money in fixed rate assets or sitting in a savings account depreciating when you can now, at honestly the best time in terms of, for example, treasuries are yielding, I believe, somewhere around like 6-7%. You can just reallocate that money into treasuries or something, get a reasonable rate of return instead of having it sit there decaying on a bank. But now this puts pressure on the bank because they have less money to loan. They have less money to invest themselves and make money themselves. So it's an interesting thing that is occurring here. And this is going to lead to ultimately more banks getting in trouble. As we recently saw that a couple of banks blew up and it's been swept under the rug so far because another bank has basically just swallowed it up. And that's kind of why I named this video the stock market nuke, because eventually one of these companies are going to blow up. They can only eat each other so much and prevent the inevitable, as has been ongoing for like the past decade. They do not want a recession to occur. They do not want a market downtrend to occur. They're basically willing to put as much money, stimulate, print as much money as possible to save the market. But eventually, the cycle has to end, in my opinion. And when I say the cycle has to end, in my opinion, we're probably going to see the end of a credit cycle in the near future when one of these institutions ultimately blows up and sets off the big nuke, or you can say the black swan event. We're going to see some crazy historical thing happen then. So yeah, smart money, institutional money, taking their money out of banks, putting it to work elsewhere. This not leads banks with less money to play with, ultimately. So in this case, that was 10% of the total deposits of JP Morgan's as of last year compared. So they basically lost 10% of their deposits from institutional money that took out $75 billion in the second quarter of 2023 from the year prior. That's 10% gone. Seeking better returns elsewhere, because why would you have your money earning jack nothing in a bank, right? Just makes sense. But this is ultimately going to lead to more banks collapsing eventually. And if we're seeing it in a monster like JP Morgan, imagine what's going to happen, or what could happen to smaller banks, as we're already seeing. So traditional banks are also witnessing a transition away from non-interest bearing accounts. Again, people are just seeking greater rate of return at a time where interest rates are pretty high. It's not that hard to find decent rate of returns in kind of reasonable conservative vehicles, right? For example, treasuries. Treasuries are bearing pretty good interest, which I'll kind of go into that in a little bit. And then ultimately, as for retail clients, retail client is just basically a Wall Street term for mom and pop, blue collar worker that uses banks just for getting their direct deposit and so forth. So for retail clients, JP Morgan says its Main Street customer are sticking with the bank in greater numbers, with retail deposits falling by 2% in the second quarter of this year. Typically, retail is always the last one to find out what's going on. And unfortunately, we see this happen over and over again. On another note, Moody's recently downgraded 10 US banks and put another bunch of banks on credit watch, or on downgrade watch. What a credit rating downgrade means for institutions, in this case banks. Basically, now when these institutions want to borrow money, whether they want to issue bonds, which you can think of them as IOUs, or whatever, they want to borrow any kind of money to fund capital expenditures or investments or so forth. Since they got a credit downgrade, compare it to a human, right, or a person has a bad credit score, or their credit score decreases. Now, when they want to borrow money, they have to pay more money for that money they're borrowing. They have to pay more interest because they're considered a greater risk to the lender. So when these banks get a downgrade in credit rating, when they have to borrow money for emergency reasons, for capital expenditures, for investments, they now have to pay more interest to borrow that money. So this tremendously affects the potential that these banks in this case have to then borrow money. So it affects their business. And we recently saw the United States government got a downgrade rating itself. So some of the banks basically, so the firm lowered the rating. Moody's lowered the ratings of 10 banks by one rung, while major lenders, Bank of New York Mellon, U.S. Bancorp, State Street, Trust Financial, Coolidge, Frost Bankers, and Northern Trust are now under review for a potential downgrade. So these are the banks that Moody's is currently watching, and they might potentially issue a downgrade in their credit rating as well. So it seems that this is just like an escalating thing. Interest rates are going up. These banks are suffering. The institutional money is exiting these banks, putting pressure on these banks to then they might have to liquidate assets to meet these depositors that are withdrawing their money. And that ultimately creates like this vicious domino effect where banks might potentially have to liquidate assets they owned, whether it can be commercial real estate, stocks, equities, you name it, to meet these depositors that are taking their money out to in search of greater interest rate return. So it's an interesting situation that is occurring right now. I find it very interesting, and that's going to lead to a lot of these banks basically blowing up, which ultimately get eaten up by a bigger bank until eventually that bigger bank sets off the big bomb, right? So Moody's also changed its outlooks in negative on 11 banks, including Capital One, that's a big bank, Citizens Financials, and Fifth Third Bancorp. Among the small lenders receiving an official rating downgrade were M&T Bank, Pinnacle Financial, big bank, that's a big bank, BOK Financials, and Webster Financials. This is basically what I'm saying. High interest rates depress the value of fixed assets. People were not willing to hold fixed assets. They're seeking higher return. This comes as a mild U.S. recession is on the horizon for early 2024, and the asset qualities looks set to decline from solid to unsustainable levels, with particular risk in some bank commercial real estate portfolios, which is typically regional banks. They tend to hold a lot of commercial real estate, and there's been rumors saying that there's something going on in the commercial real estate market. So the panic eventually spread. This just goes to the connectedness of the world. So of course, recently Signature Bank, Silicon Valley Bank collapsed, and this sets off a global panic. The panic spreads to Europe, and the result in the emergency rescue of Swiss giant Credit Suisse, a bank that should have died a long time ago. Is a zombie company that is just doesn't produce anything. That company should have been dead, but what happens? It was acquired by USB or UBS. A domestic rival bank acquired a failing institution, what always occurs, which ultimately these smaller bombs lead to the nuke, the big bomb that eventually is going to come out of somewhere. Where? I have no idea, but we're seeing this happen over and over again. These failing institutions are being acquired by a larger institution, and they're acquiring not a very good business. Moody's warned that banks with substantial unrealized losses that are not captured by their regulatory capital ratios may still be susceptible to sudden losses of market or consumer confidence in a higher interest rate environment. Fed Reserve rate is currently hovering between 5.25% to 5.5%. And then again, regional banks are considered a greater risk since they have comparatively low regulatory capital. Moody's noted, adding that institutions with a higher share of fixed rate assets on the balance sheets are more constrained in terms of profitability and ability to grow capital and continue lending. Through the stress on U.S. banks has mostly been concentrated in funding and interest rate risk resulting from monetary policy tightening. Moody's warned that a worsening in asset quality is on the horizon. So basically, Moody's saying asset equity prices are going to go down. There will be likely a tightening of credit conditions and rising loan losses for U.S. banks. Tightening of credit condition basically means banks are now going to make it harder to borrow money And that basically kind of stops the clock. Less loans going out, less borrowing of money, less things being bought. We live in a world where everything is basically finance, and everything is leverage. There's leverage on top of leverage on top of leverage. And that has been working for a very long time because of low interest rate environments. This is interesting, which I've been watching. This is basically so government current receipt and expenditures. This is the interest rate the Federal Reserve is paying to Treasury on the government's debt. So the Federal Reserve basically is paying close to a little bit over $1.2 trillion in interest. That is a lot of money the Federal Reserve is paying in interest. How long they can sustain this, or to eventually this becoming a problem, have no idea. But they're paying a whole lot of money in interest due to interest rates being high, right? So that is something interesting that I've noticed. And only way they're going to meet these obligations are two ways. They're going to have to print more funny money. They're going to fire up that printer, causing potentially further inflation down the road, because that is a problem now that didn't occur in the past. For example, in the 2008 crisis, inflation wasn't an issue, but it is now, which puts their back against the wall as to how much money they can print. Or they're going to have to dramatically increase taxes, which corporations don't like, and they have a lot of influence. And I'm sure they will do anything they can to prevent that from happening. And then lastly, the bond market is a mess. It has equity prices, or the equity price of bond prices, have dropped dramatically due to rising interest rates. I keep going on about this because think about it. If you buy a bond from the government and it's paying you 5% interest rate, and then next month they release one that is paying 6% interest rate, which one would you rather have? The one that's paying you 5% interest rate, or the one that's paying you 6% interest rate? Of course, one is paying you 6% interest rate. So that causes the actual equity price of the bond paying 5% to drop. And bond prices have been getting slaughtered. This would be the equivalent of the early 1990s, which they call the bond market slaughter. The cool thing about bonds, if you hold them to maturity, you're okay. But if you have to liquidate them before maturity, you take a major loss, which that is what's been going with a lot of these banks. They're holding on to big paper losses. That's what occurred to Silicon Valley Bank that led to them to collapse. Depositors, institutional money, smart money, took their money out of the bank. Bank had to liquidate assets they were holding paper losses on to meet those depositors' withdrawals. Boom, bank imploded. Basically what happened to Silicon Valley Bank. And yeah, with that being said, let me know what you guys think. This is some research I've been looking into and I find it very interesting. So I'll leave you guys with a market quote. We are holding on to that stock just to avoid closing our mental accounts at a loss. It's the disposition effect. Basically, sometimes people are willing to hold on to their losses longer than they're willing to hold on to a profit. And with that being said, if you guys liked what I shared with you today and would like to hear more, please like and subscribe. I appreciate your time. Thank you for that. And I'll talk to you guys soon. Have an awesome week.